All right, everyone, we're going to get started. Thanks so much for joining us. First of all, I want to let everyone know that we're recording this webinar and we'll make it available this week. Also, we have closed captioning available, so if you'd like to take advantage of that, you can see the visual here on the screen. You can click the closed captioning button and go from there. So thanks again, everyone, for joining us for our webinar on what banks need from their technology stack to support consumer financial health. I'm Laura Cummings. I'll be your moderator today. I'm a director at the Financial Health Network and also a co-author on our recently released report of the same name, what banks need from their technology stack to improve financial health. So to get us started, we'll do some introductions with our panel participants, which you may be able to see here on video. Then I'll take you through our highlights of our recently released report, and then we'll jump into our panel discussion. And we will also make sure we have time for Q&A with our panelists, and then close out. So we have a short hour together. So I also wanted to point out that we are looking forward to hearing from you. And if you could use the Q&A or the chat function to ask questions here, we'd love to share those questions with those here, and we will make time to do that later on. So let me introduce you all to our panelists today. We have Erin Caldwell from MX. She's the Director of Client Voice at MX, which is a Utah-based fintech that enables financial institutions and fintech companies to collect, enrich, present, and act on data intelligently. We have Jeff Klein from MDC. He's the CEO at MDC, or Members Development Company, which is a consortium of over 70 large future-focused credit unions. MDC's owners pool resources to enable relevant research, develop innovative products and services, create valuable vendor relationships, and share knowledge, provide economies of scale, and keep consistent focus on the horizon. We also have my co-author here, Corey Stone. He's an entrepreneur in residence at the Financial Health Network and a senior advisor at the financial services practice of Oliver Wyman. Corey was part of the founding executive team for the Consumer Financial Protection Bureau and served as assistant director for deposits, liquidity lending, and reporting markets. He has experience on boards of a bank, credit unions, and has held executive roles at a money transmitter and alternative credit bureau. So thank you all for joining us today. I'm going to jump into the highlights from the research report, which we just released. First of all, I need to thank the Kresge Foundation for their support. Without their support, we wouldn't be able to have the webinar and conduct the research that we did. There we go. Oops, too far. So first, a little bit of background on why Corey and I took on this research, why we wanted to understand the relationship between banking technology and consumer financial health. So at the Financial Health Network, our mission is to improve financial health for all. In our 15 years, we've done extensive research on the financial lives and challenges of Americans. And we brought together a network of innovators to meet the needs of their clients, customers, and employees. And in working with this diverse network of fintechs, large banks, credit unions, nonprofits, we often heard about barriers coming from banks and credit unions, technology, that they were highly dependent on their banking technology for the products and services that they offered to their customers or members. And that when we spoke about innovating to improve consumer financial health, they often look to their vendor to really think about what those products would be. This is especially true among smaller financial institutions. And by smaller, I mean 90% of financial institutions. In those situations, we really heard that the technology providers were providing the whole suite of services to the financial institution, everything from the core processor to the digital banking interface. And at the same time, we were observing fintechs offering products directly to consumers that help them to save or pay down debt and overall manage their money. And we were curious why financial institutions weren't either innovating to provide those themselves or doing some sort of copycat, really to get those products in the hands of their customers and members. So to do this research, we conducted over 36 interviews, talking to banking technology providers, to fintechs, to banks and credit unions to understand the dynamics at play. And one of our primary findings was around the complexity of the technology stack, or more specifically, the importance of the customer financial data that is housed in the technology stack and how that gets used, ultimately served up to bank employees or customers is really critical in being able to use that data to the benefit of the customer. So what you see here on the screen is a simplified view of the tech stack as we mean it. So the core processor there at the bottom, performing kind of basic functions as the system of record. Above that, you have all sorts of functions to move and manage money, from loan origination, loan servicing, debit card processing, bill pay, all these services that financial institutions offer. Above that, we have a little box for middleware, so an in-between system. And then above that is the actual interface of the day-to-day bankings, where individuals can see what is happening within the system. The takeaway for us is how complex it is. So there's many different systems that are keeping track of where money is going or should be going, and who's owed what, where the money needs to be. Ideally, it's presented to the consumer in a very simplified way through their digital banking system, via the ATM, all sorts of interfaces. Bringing all this information together is critical for developing products and services that can help consumers to better manage their finances. And I'll walk you through some examples of what we mean there. So my first example are safe to spend or safe to save types of products. So we know that such things can be built. We know there are apps available right now that do this type of analytics and help a consumer understand whether there are excess funds available that can be swept into a savings account, or whether they are getting ready to run out of money, to try and predict what they have available in funds. But what we don't see are a lot of banks and credit unions being able to offer this, that consumers have to go find it through third parties. And that was really one of our main questions, is why consumers have to use outside services to get access to products that could help them to understand their finances. And what we heard is it's very difficult for a financial institution to find a third party to offer such a service, because then they would have to integrate it into that complex system that we were just looking at their technology, their core processor and digital banking layers. And that's very difficult and timely and costly for financial institutions to do. A second example of a financial health product or tool that we see available to consumers, but not through their traditional financial institution, are earmarking products. So the thinking is, it's when income comes in, it's ideally one matches your expenses right when that income comes in to your known expenses. And this has been practiced manually by individuals and is really encouraged as a way to manage money in a way that matches the timing of income and expenses, even if that's not naturally occurring. As I said, these products exist as apps or other kind of plugins that consumers can use, but are less available through traditional financial institutions. And a third kind of use case that we were really interested in is customer analytics. So we know that customer analytics are really important for being able to understand consumer financial health needs and challenges. Banks and credit unions benefit from bringing together all that data that is spread across the many systems that we laid out if they want to get a full picture of their customers. This can be used internally to better target products and services to customers. For example, looking at maybe deposit patterns among a customer. You could identify those who have volatile incomes versus those who have stable incomes and match them with the right savings product. Or to identify someone who's suffered a loss of income, do proactive outreach. But if this data isn't all brought together, it's impossible for the financial institution to identify that. So in our research, we came across at least three promising pathways for how financial institutions are getting access to their own customer financial data. The first are data aggregators. So when I mentioned, Fintech products that consumers are using, some of you on the webinar thought immediately, well, yes, they're using a data aggregator to be able to see the financial transactions that are occurring within bank accounts. And that exists, that need exists, because otherwise there isn't easy connectivity between a fintech and a bank data. Another trend or kind of workaround that we see a lot of financial institutions using is middleware, which I mentioned before is just another software layer in this case to bridge the financial systems and a customer analytics database, a business intelligence platform, some way to bring all that data together to make it useful for the financial institution. And a third trend that we heard about when talking to a lot of the core processors is a move toward open APIs and a move towards core processing platforms becoming more of a platform that can integrate with third-party products and services. So as I mentioned, right now, we don't see a lot of financial institutions using third-party products that aren't offered by their existing bank tech vendor. But with open APIs, that type of connectivity could be hopefully less costly and more available to the vast majority of financial institutions. So with that preview and kind of quick summary, I'm going to take it to our panel now to really talk about how they see this happen in within their institutions that they work with. Right here. So I'd love to start with you, Jeff, because Because I know at MDC, you work with a network of over 70 credit unions, which reach nearly 16 million Americans. Can you share how you've seen credit unions struggle to offer FinHealth tools, or how this resonates for you all, specifically around the tech stack?
So how much time do we have?
Let's get us started.
Yeah, you kind of throw me a softball there. I could talk about the struggles for the next 2 hours. And if we had more time, I could share an example of a new company that exists because of one of our projects and the way the technology actually got in the way of one of the solutions that our credit unions really loved. But I would say that when we think about the way technology enables, or the way, the role that technology plays in the space, it probably is more of a role of impediments more than solutions. But there's a lot of people out there, working on solutions. And you mentioned sort of the spaces, the APIs and the aggregators that are in the middleware. I mean, all of that's really being built almost because of the lack of functionality of, starting with the cores primarily. And we have, again, I would love to tell you the story about, the project that was supposed to be a PFM tool to help a group of consumers that was found via some market research we did, that eventually led to, gee, we're going to create a middleware, that led to, ooh, that's going to be a big expensive project, to a group of credit unions raising $30 million to form a company to try to do just that. And so we do find a lot of impediments to these things. And when you think about finding an app that you really love, that you want to offer your members, and then you go, oops, now I got to spend tens of thousands of dollars to interface this app to all these technologies. And then I got to spend money to continue to maintain those connections. And maybe this technology only is really designed to serve a persona that might represent 10% of your checking accounts. And that by the time you take 1% of 1%, the people you're trying to serve and the overhead of doing that just makes these apps, infeasible.
Mm-hmm. Thank you. And Aaron, would love to hear your perspective on the challenges we faced in 2020. The stay-at-home orders in the spring, I think, really highlighted the need for Americans to have access to digital banking tools that are effective if they can't go into the branch. Can you share what your customers, which are banks and credit unions, how they experienced this, increased demand for digital banking this spring?
Yeah, absolutely. I mean, I think the point that Jeff was making about the challenge and the difficulty of kind of creating the right experiences has been more acutely felt this year than before, because of the behavior shift that we've seen amongst consumers. I think across the board, we've seen major drops to in-branch banking. I want to say, pre-COVID, we were looking at something like 60% of what branch traffic had been a decade prior. And since COVID, we're looking at 60% of that. And we're seeing, of course, huge increases in digital engagement. So I think that's something everyone has experienced, but from MX's perspective, amongst our users, we've seen a 126% increase in average monthly logins, or we saw that in April, over the January baseline. And it makes sense in April, particularly when you had a lot of people logging in to check to see if they had their stimulus checks posted yet. But even now, 5 months later, we're still at 109% of what we were seeing back in January. Looking at like specific features, we saw a substantial spike in features across the board in April, with just about everything that we offer being utilized more heavily now than before the pandemic, except for branch locator, which has decreased. So I think everyone felt a pretty big spike when the federal stimulus funds were posted, and the sudden increase brought a lot of online systems down, which I think exposed some gaps in digital infrastructure. I think, you know, infrastructure improvement projects aren't super sexy. It's not like the thing that easily gets a lot of excitement going around the organization. But I do think that's something that we as an industry should be paying more close attention to right now, and making sure that we have the capacity to deal with more heavy digital and mobile engagement than what we were seeing before, because online banking engagement is up, mobile banking engagement is up, and I don't think you're going to see much of that move back into branches when the threat of COVID has passed. Because once people make that behavior change and realize how much more convenient digital is for their day-to-day banking needs, it's very unlikely that they're going to reverse course and change behavior back to what they were doing before. And I'll just share a quick example. You know, I think of my dad, who has had a smartphone for years, but doesn't really use it for anything besides calling, texting, and some browsing. He was still doing the majority of his banking by phone and ATM. But when COVID broke out, all of a sudden the wait time for a phone call to make his payments was hours long, and that just wasn't going to do. And so he reached out to me for help. Hey, how do I do this stuff online? Because I can't wait 3 hours to get through to someone. And as I dug in with him, absolutely horrible digital experience. It was so painful to try to do anything that it was easier for him to go and switch to a different credit union that I recommended to him that had a really great digital experience. And we got him set up with a mobile banking app that can do everything that he was calling into the bank for before. So yes, it took a little bit of effort on the front end for him to switch and get set up with a new institution. But do you think he's ever going to go back to telephone banking? No. Digital is just so much easier. So I think that's something that we've experienced pretty broadly across the industry that is not likely to reverse course by much once this period has passed.
Mm-hmm. Yeah, that's a great example, Erin. Thank you. Corey, so in our research, we came across the term PFM 2.0, and I'm sure some people who saw some of the examples we walked through earlier thought about, okay, that's personal financial management, that's PFM. Could you share with us, you know, what we think of when we think of PFM 2.0? What the differences would be for consumers? He might, I thought he was just listening intently, but I think he's frozen. Well, I'll take that one for him. So one of the differences, I think, between PFM 1.0 or kind of traditional personal finance management is one is kind of a dashboard and a view of all your finances, which is necessary, right? One place where you can see all the financial products you have within an organization and your balances all in one place. When we think of PFM 2.0, we're really thinking about using technology to take off the burden from the consumer of managing. So one would be information. PFM 1.0 would be kind of information. PFM 2.0 would be like action, helping individuals kind of make quick and kind of analytical decisions with their money. So when I think about those safe to spend or safe to save products, not only are they analyzing whether an individual may have money left over at any given moment, but they can also take action for the consumer and move the money to a savings account or transfer money from a savings account back to a transactional account to avoid a fee, that sort of thing. So it's really coupling that information with analytics, with action.
Laura, I'd love to jump in here. The way that I think about it is that PFM 1.0 was very much backward looking. So if you look at a lot of the personal financial management tools that are on the market today, it's a matter of looking at, okay, where am I right now? And how did I get here? So we're looking at things like current account balances, transaction history, recent spending, You know, that's all very much PFM 1.0. PFM 2.0 takes us into more of a future facing perspective, where we're looking at your past patterns and your financial habits, and we're projecting forward what that's going to look like for you in the near future. So projecting cash flow, projecting transaction behavior, anticipating upcoming bills, and then providing little alerts or nudges to let you know, hey, you've got this bill coming up on this date, but right now your balance doesn't look like it's sufficient to cover that, and you're not anticipated to get another paycheck until the 20th. You might want to move some money from savings over to your checking account to make sure you're covered for this bill. And then to really make it special, let's make that possible with a click and say, yes, let's move this. I would like to initiate this transfer. Or another example, hey, you've been spending less on dining out over the last couple months. That's awesome. You now have an extra $200 in your checking account that we don't think you're going to need. Would you like to move this over to savings? And then say, why, yes, I would love to move $20 or $50 or whatever the algorithm comes up with as a safe amount for you to save over to that savings account. In my ideal world, we end up building a banking experience where you hardly have to think about it at all. It's just there, and we tell you this is where you are, this is what's going to happen next. Would you like to approve this small little action that fits within your ability right now to increase your savings or tweak your spending or make those small micro adjustments to consumers' financial behavior that helps them move the needle in their financial health, not just in terms of their account balance and savings is now a little bit bigger, but we're creating that behavior of, oh yeah, I can save a little bit from month to month, and kind of shifting that paradigm.
Yeah, and if I could jump, I just like to tag on to that a little bit too. When I think about it, as we think about these tools, and Aaron and I were talking briefly about, real-time data and the ability for some of these apps to be able to benefit us as we're doing things, and you can start thinking about personal financial coaches on your phone. Not a person, but the tool, and go, oops, you told me you only wanted to go to Starbucks 5 times a month. I know some of you are freaking out, 5 a month, but and you could have geolocation built in there. Are you in a Starbucks again? And be able to sort of nudge you and make this stuff very interactive. And so the more real-time the data is, and the more tools you can link into this device that we all carry around with us now, the more this can help you not just anticipate, but help you prevent the things you're trying to do. Oh, wait a minute, you're in a restaurant? You're over your budget this month, and things of that nature that, because I'm a recovering CPA, and so when I came out and started working at a financial institution, I building back then a Lotus 1, 2, 3 spreadsheet to download all my activity, to put it in Excel, to categorize it, look backward a month to see how I did. And it's the 10th of the new month, and now I'm worried about what I did, back then. But we can take that all, take what Aaron said and take it another step further and go, it can help us real time what I'm doing with my behavior right now.
Mm-hmm. Great example. Jeff, I would love to hear more about the partnerships that you're really promoting at MDC between your credit union members and fintechs, because I know that's something you're really passionate about.
Yeah, another one of those. Okay, if I had 2 hours, send me an email. I'll bore you to death with a phone call. But yeah, we have a lot going on in that space because we're sort of focusing on it from the credit union industry's perspective. We all know the dreams of the two gals in a garage developing this thing that they're going to go sell to Wells Fargo for millions of dollars, and then they can go live on the beach for a few years or start their next app. But from our perspective, while most of us are probably getting more phone calls than we know what to do with from fintechs, we know there's hundreds and hundreds, if not thousands of them out there. And we see our industry as sort of an afterthought. And so we're trying to approach this sort of on a multifaceted level. One is we just have semi-annual Fintech expos. So when they approach us, I have something I can promise them and say, hey, you know, every 6 months we're going to do an expo and we're going to put 20 or 30 of you in front of our credit unions and then see how that goes and see how we can develop partnerships from that. But we sort of see that as just a small piece of a bigger ecosystem. And so we're working on some infrastructure, some tools, maybe a website, a database to have a place where fintechs can come to us, to the industry, and apply to be part of this ecosystem. And so the expos are one thing, but there are other expos out there now, so they can become part of this thing. So it's not an MDC ecosystem, it's an industry ecosystem. So we might have many of those, we'll all call them Money 2020s or Finabates, but you know, smaller, more targeted type entities that we can do those things maybe every month. That we're going to, we are actually getting ready, probably in the next 60 days, to launch a credit union fintech venture fund. And so so it'll be the first time credit unions can put their money together in a fund that can be professionally managed, that can be run like a venture fund, different priorities. You know, ours isn't to get the, find the next Google. I mean, that'd be great, but it's really about finding the important technologies that can make a difference for credit union infrastructure or for credit union members. And so that's sort of the first priority of the fund. Yes, we want it to make money, but this way we don't have dozens of credit unions out there, each of us looking at fintechs, and in some cases the same fintech. But having the gal that runs our digital banking is the person we send all the fintech calls to, and now she's trying to juggle all these fintechs and look at them and if this makes sense. Oh, I'm not the lender. I got to go talk to the lending person about whether this even makes sense. Oh, they want an investment. Now I'm an investment fund manager trying to decide how much money I'm going to invest in this thing as a credit union. And we want to sort of get rid of all that duplication and try to say, let's have a professional manage our money. They can invest your $1 million in 20 or diversified across 20 or 30 investments as we put this $100 million to work for the industry. So that's some of the things we're doing, and obviously it was really fast. I'm sorry if I was talking too fast.
No, exciting though. Exciting.
Yeah, very.
Looks like we have Corey back. Welcome back. Awesome. So Corey, question, you got to come off mute though. Question for you. In doing this research together, can you share with us kind of your takeaways about the trends that we identified? Like, how are those going to be translated into improving consumer financial health?
Well, the apps that you talked about, Laura, all rely on data that's available and available in real time. And you can't build the apps without it. The challenges have been a combination of technical and business model barriers that app developers face. Middleware providers like Jeff bridge that gap so that it's easier to integrate once with somebody who's kind of built a set of intermediate APIs than it is to try and negotiate with a platform provider or for an individual entity to build their own middleware layer. So that really is a positive development, and it will move the business environment towards better experiences than are currently available. Hopefully that'll set in motion a competitive dynamic where the platform providers will see their own client benefits from easier integrations and then make their own APIs more open and more economical at the front end, and hopefully not extract too much per data call on the back end. There is the alternative of using data aggregators, which is the origin of MX's business. They've evolved quite a bit, from that model. But instead of having an API, you integrate once with an aggregator who's already organized the data for you and created particular data calls that you can just make to power your apps. That's a great benefit in the ecosystem that has really evolved very quickly.
I'd love to just jump in here. I love the shift that I'm seeing towards this like ecosystem thinking in our space, because something you'll hear MXers say a lot is there's no such thing as a silver bullet, just truckloads of lead ones. There is no one way that we're going to crack this connectivity problem. It's a big, complex problem that plays out in different ways, in different use cases for financial institutions and fintechs. And I think it's going to require the various different approaches that we've started taking as an industry to bring that data together. So yeah, aggregation, traditional aggregation still has a place in this space, but we should be moving more towards open finance, open banking, APIs, where there's a more direct and a more secure, a more tokenized approach to controlling and sharing and accessing data. And then middleware and starting to build out these kind of connection layers between the core and other services, I think is important as well, because when you look at aggregation or open banking, the data that we're looking at there is somewhat limited. We're looking at accounts and transactions and maybe some other elements, but there's a lot of other pieces of data that exist within the systems that financial institutions are working with that you may want to be able to pull into your data ecosystem to power different experiences. So I think there's an important place in this conversation for all three of those elements, and they solve for different use cases and how we want to build and customize and tailor the experiences we want to deliver.
Erin, there's one more kind of use case I want to make sure we dig in to a little bit more, which is the analytics that a financial institution can use internally. So better understanding their customer data. Can you share with us some of the insights that you think are particularly helpful for a financial institution when they are able to aggregate that data together and get a bigger picture?
Yeah, sure. So, I mean, if you're working with externally aggregated data, or with MX, we have a tool called Discovered Accounts that leverages your internally held data to identify some of those same external relationships. There's some really great opportunities to grow wallet share while improving the financial health of your users. So you could, to use a marketing example, generate a segment of your users who are paying high interest rates on competing loan or credit products, and then provide them with a targeted offer for a more affordable credit or loan alternative. So looking for those win-win opportunities where it's like, hey, you're paying more than you should be for this product. I can do better for you, which helps me as your financial institution to grow my wallet share, to strengthen my relationship with you, but also is going to save you, X amount per year. We've got within our MX product, we've got a certain type of campaign or offer that we can deliver to users that actually breaks it down for them and says, John, you could save $1,281 per year by switching this credit card over to the one that we provide. So doing that math for them and helping them see very clearly what their personal ROI is for taking action on that offer. But even if you're just working with your internally held data, there are some great opportunities to better understand your users, which should influence the way that you try to serve them. So our new analytics suite has some really great dashboards on specifically consumer financial health and spending behavior. So on spending behavior, for example, where are people spending their money? And something we've seen throughout COVID is we've, of course, maybe it's not, and of course, maybe it's not assumed, but we've noticed dips in spending across the board, most noticeably on discretionary categories such as dining out and entertainment. Interestingly, spending at Home Depot specifically is up. So it seems that as people are spending more time at home, they're looking to make some improvements, myself included. I'm in the middle of finishing my basement right now. So it gives you some insights like that give you more of a deeper look into what's going on in the spending world of your consumers. On the financial health dashboard, we're leveraging our FinStrong financial health scoring model to analyze users' data to identify How many of your consumers are financially strong versus struggling? For those that are struggling, where are they struggling? And all of this is, I think, a great starting point for some really interesting UX research to identify the right ways to help. Because not all consumers are different. The things that your consumers need are going to depend on where you are in the country, how hard you've been hit by this crisis, the makeup and demographics of your user base. And so the way to solve for financial health for your consumers is going to be different based on those things. But by better leveraging the data that you have on your consumers and their financial situation and their financial behaviors, you can better identify more specifically the potential gaps in your products or your services that are resulting in your users being underserved in some way, or changes in their behaviors or their needs that may influence small shifts that you want to make in your products or services. So I'll give you one example. I can't remember who I was speaking with, but someone I was speaking with recently had shifted their mobile deposit limit from $10,000 to $50,000 through the COVID crisis, because they saw the increases in mobile activity. They saw the increases in call volume around the need to make large transfers. And so they decided to increase that limit from $10,000 to $50,000, which is a huge jump. And I'm sure made their fraud team just like grimace and groan with anxiety. But throughout this whole thing, they've had one attempt at fraud, and it was caught and shut down. And so it hasn't, had any negative impact on them, but definitely had a positive impact on their users' experience and their ability to do the banking activities that they needed to be able to do without going into a branch. So some really powerful opportunities to leverage the data that you have for some interesting UX research that should drive some changes in your approach.
Mm-hmm. Great, thank you. I want to encourage the attendees who are listening in right now to add their questions to the Q&A icon here on the Zoom platform. I'm going to start looking at some of the questions we've already got. Sorry, I think that was just so one question we got was talking about that example we were all imagining earlier about having kind of real-time data and using your phone to keep you accountable to some of your budget goals. And one attendee was asking, how do customers feel about that? And, do people really want so much surveillance of what they're doing? And does PFM 2.0 have a chance to kind of be off-putting to consumers? I don't know if you all have comments up there.
Yeah, I'll jump in there. I think a couple things. One, I look at some of that sort of like actual fitness. Not everybody has a gym membership. Not everybody wants to, track their stuff. I have this watch that has literally changed my life because I'm a type A person that tracks everything. And so now I'm on this 165-day stretch of exercising, right? So I opt into that, right? Lots of people have this watch and don't even know there's a fitness tracker on it. So those kind of apps you opt into, in my opinion. And not to get off on a tangent, but that's exactly why we have this connectivity problem. Because if we had, in a perfect world, if Aaron could solve all of our problems and any app could talk to any core, then the institution can open up and I can say, well, I want to be tracked this way, and I want to be tracked that way, and I want to use this app and that app and that app. And I don't want any apps gone. I don't want anybody tracking me. And I got my geo tracker off, and I don't want to know where I'm going, as opposed to this is important to me. And now I can take advantage of these really cool tools that the two gals in a garage built, but it don't talk to my financial institution. So that kind of thing is very personal. But we're the ones who want to do something about it. They have to use the app in some other way because it won't talk to our shops. And so it's that ability to go, I can talk to any app that makes this whole conversation so important so that I can use the ones that personalize and benefit me.
Can I just take a slightly different slant on that? I've just spent a fair amount of time sort of researching what are the fintech apps that really are moving the needle. And it turns out that a lot of them are things that people do for themselves. And they do them in a kind of manual, kind of kludgy way that requires a lot of attention. The earmarking example is a good one. It turns out if you talk to a lot of credit unions or banks that a lot of people use their special savings account to move money out of their checking so that they won't spend it and set it aside for the big bill that they pay. Then they have to sweep it back in so that they can make the payment. But what they're doing is a kind of digital version of the old paper envelopes model of taking your paycheck, cashing it, and putting in for a week's pay a quarter of your rent, so that at the end of the month, after 4 weeks, you'll have the full rent. These things can all be done digitally if you make them available. And kind of a lot of the behavioral research is not so much based on what people say they want to do, but actually, what are they actually doing now that we can make easier and better and work more consistently for them.
And I'm just going to footnote that, Corey, the app I alluded to earlier that we wanted to build for our credit unions 6 or 7 years ago, that we got into that, it serves 10% of our checking accounts and it was not enough people to justify it, was driven by consumer research and ethnographic research on the streets of Chicago. And the app we were building was an envelope app, because some of these people were literally taking money physically to different institutions to hide it from themselves to create their envelopes. And so that was the very app we wanted to build 6 or 7 years ago that the technology and the middleware wouldn't allow us to do.
Mm-hmm. Yep. Another question we have here, maybe building on what we were just discussing, is knowing that fintech tools can help people, especially those who aren't keeping detailed track of their day-to-day finances. How do we go about getting them to try one of these tools, right? So if they're not already doing it and it's just a transfer of behavior, how do you incentivize or get someone to try a new tool?
A small piece of that has to do with the data analytics. So if you see somebody in your analytic data who's exhibiting a particular kind of data, for example, the sweeping in and out of a special savings account, then you know that they are ripe for a particular app. Or if they're having a particular problem, let's say they're overdrafting a lot, but you can see kind of erratic patterns of discretionary spending, particularly around the end of the month, where people may be guessing about when things are going to clear and gambling. You could help them by, you would be able to identify them and target them for a particular app that might be particularly helpful for them. This raises a completely separate issue about the business model for these apps, and ultimately perhaps the need to charge for them to make up for what hopefully would be lost overdraft revenue as people are better able to manage their financing in this particular case.
Can I tag on to that too? Brenton Peck with the Financial Health Network and I were doing a wrap-up presentation on a project that he and I had been working on around fintechs and baby boomers and all the woes they have from a financial perspective. And we were in a breakout session with a bunch of people who were passionate about this very topic that we're talking about. And some of the feedback we got really spoke to how tough a time those individual managers had within their financial institutions getting these things high enough up on the strategic plan. And so one of the things that Brent and I concluded, and one of the things that I'd love to do some work on, would be how important is this really to the financial institutions in the United States? And if it is important, how many of us are seeking out ways to measure financial health? Because it's not the same for a 25-year-old and a 55-year-old, right? So how do you create scoring tools? How do you then accumulate the data that Aaron was talking about earlier so that I can score the households of my entire membership, create an average score, and then how does my corporate scorecard incorporate the need to improve those scores for the households of my membership? And so I think some of this is strategic. Credit unions talk a lot about this, and I do think it's important to them. But I'm speaking a little out of school, but I would say there's a really good chance that kind of metric is not part of a corporate scorecard and a team's bonuses at more than 90% of credit.
So with that, I would love, Misha, if you could help us get the slides back on the screen. I'm excited to share a new product that the Financial Health Network is releasing to help institutions measure financial health, which is what Jeff was, yeah, I'm gonna take the opportunity there. Because what we've talked about today are some of the challenges that the technology presents, and kind of knowing that how difficult it is to build something in-house. We really want to share a new product we've developed to help institutions quickly survey their customers to understand their financial health. So this product really makes it easy for an institution, financial institution, large employer, what have you, to quickly survey with this beautiful app that is animating right now. It'll ask the 8 questions that we use as a part of Financial Health Network's score, and then quickly analyze that information and present the institution with a dashboard that compares the results from their survey to benchmark data. So the Financial Health Network has the nationally representative survey of financial health in the US, and we can benchmark different segments to understand the financial health of customers, members, or clients. So that's coming next month as a quick and easy solution to the measurement challenges the institutions face. I want to thank my panelists so much for joining me today. I'm going to walk us through just 2 more offerings we have here at the Financial Health Network, and then close this out. So first of all, for our network members who are here today, mark your calendars. That includes MX and MDC. For our member summit, so we're because we're going virtual, it is staggered throughout October, October 7th and 8th, 14th and 15th, and the 22nd is our member summit. Also in October, we have our Emerge Insights. So October 20th and 21st, we'll be releasing the results of the 2020 U.S. Financial Health Pulse. We'll also hear from experts on behavioral science and other measurement topics. Oops, sorry. So thank you all so much for joining today. Again, this will be recorded and we'll share it again over email. And if you'd like to be in touch with us, you can reach myself, Laura Cummings, and Corey Stone through the Financial Health Network. Again, Aaron Caldwell's with MX and Jeff Klein with MDC. Thank you so much.
It's great to be here.
Thank you.